In 2017, Hurricane Irma hit the United States. That storm alone damaged or sunk 50,000 recreational boats in the United States. Later that year, Hurricane Harvey wrecked 13,500 boats. On average, 1 to 3 ships are lost to storms each year, which is a minuscule amount compared to these smaller recreational vessels. While a hurricane or typhoon may batter and bruise a large ship, they are designed to take a significant beating from Mother Nature. 2025 has felt a bit like watching a hurricane form over these seas. The waves are slowly picking up on the shoreline, steadily crashing harder and harder. There is certainly a storm brewing, but the question still remains just how big the storm will be. It could pick up enough steam to do some real damage, but it may calm down before it reaches the shore. The Atlanta Fed's GDP Now estimates that the gross domestic product for the United States will contract by roughly 2.5% in Q1. When adjusted for gold, that drops to just under 0%, but still a contractionary quarter is expected. A recession in the U.S. is certainly a possibility, but it's certainly not a foregone conclusion either. The U.S. economy is a complex interaction between millions of different consumers and the individual decision-making of many different businesses. It also depends on our trading partners in other countries. And as we saw in 2022, just because the experts are predicting a recession doesn't necessarily mean we will have one. Relying on forecasters to predict recessions in order to protect your portfolio is a bit like relying on meteorologists to protect your tiny fishing boat from storms. It's far better just to own a bigger boat. Storms will come. It's just a matter of time before your boat is going to be put to the test. And that's why we focus our portfolios on high-quality companies. These can be thought of as the gigantic, large freight ships in the ocean. They are built to withstand a significant amount of economic abuse. You may have heard one of our advisors talk about security, income, and growth. We intentionally have security at the beginning, representing the number one most important thing we're looking at when constructing investment portfolios: security, income, and then growth. As it turns out, however, there is a wide body of evidence that suggests both security and growth often come from the same place, and that is high-quality companies. From 1994 through mid-2020, the S&P 500 Quality Index generated annual returns of 12.5% per year, compared with the S&P 500 Index at 9.8%. The word quality gets thrown around a lot, but what exactly do we mean by a quality company? Research shows that quality companies can be defined by 3 things. The first is high and stable profitability. The second is strong free cash flow. And the third are healthy balance sheets. When evaluating a company to invest in, the first thing we're looking for are these 3 criteria. In this particular environment with uncertainty around tariffs, we're adding 5 additional criteria to our search process, and that is represented by the acronym PRIME. That stands for pricing power, resistant to tariffs, innovative, management, and essential. These are characteristics we look for regardless of environment, but we think they're particularly important as we finish out 2025. Let's go through each of these one by one. The first is pricing power. Warren Buffett said that pricing power is the single most important decision in evaluating a business. He says if you've got the power to raise prices without losing business, you've got a very good business, and if you have to have a prayer session before raising the price, then you've got a terrible business. Between 2018 and 2019, when President Trump introduced 10% tariffs on incoming goods from China, not all of that 10% went on to affect consumers. Research shows that furniture prices, for example, only increased 2.3%, which suggests that the furniture manufacturers were absorbing a significant amount of those costs without increasing prices to their end consumers. While all companies are subject to the same environment, not all of them are able to handle them the same. Just like the same weather will affect two different boats differently, the same economic environment will affect two different companies very differently. While one may not be able to pass on price increases to the consumer, other companies will easily be able to pass on any impact from tariffs to their end markets. We want to buy companies that are able to pass those price increases on and protect their margins. Dividend growth itself can be an excellent indicator of quality. Research has consistently shown that dividend growers and initiators tend to outperform the average company. Ned Davis research finds that an equal-weighted portfolio made up of dividend growers and initiators, rebalanced monthly, generated annual returns of 10.2%, compared with just 7.7% for the average company in the S&P 500 and 4.1% for non-dividend paying stocks. The R in Prime stands for resistant to tariffs. There are some industries that are naturally more exposed to tariffs than others. Automakers, for example, are exposed to steel and aluminum prices and many other raw inputs that are required to make a vehicle. They also sell big discretionary items that are easy for consumers to delay or cancel. Retail and apparel companies are also at risk. For example, Nike has major factories in both China and Vietnam, both facing higher tariffs on imported goods. One example are defense contractors. As we do less and less trade with other countries, the probability of going to actual war, not just trade war, with those countries also increases. Countries are likely to increase their spending on defense just to protect against this possibility. Utilities are another sector that are largely immune from tariffs. Not only are their products almost entirely US-based, but their rates are fixed for a period of time, and they are absolutely essential for most households and businesses. Finally, digital service companies like Microsoft and Constellation Software are largely immune as they are digital products and not subject to tariffs. The I stands for innovative. And while you may think of big tech or maybe social media companies when it comes to innovation, not all innovation is just restricted to technology. For example, automatic data processing and Paycheck both use their massive amounts of data on employees to deliver insights for employers using their AI technology. And waste management turns an otherwise wasted byproduct, which is methane from landfills, into gas that can be used to power their trucks and sell to utility companies. And innovation typically shows itself in consistent earnings growth. Growing earnings year after year is rare, which is why it's often rewarded by markets. From 1979 to 2019, only 356 of the top 1,000 U.S. companies were able to grow their earnings by more than 10% in any given year. That's only 24.5% of the 1,000 companies. Only 76 of those companies were able to grow their earnings by 10% for 3 consecutive years, which is just over 5%. And only 22 companies, or 1.5%, were able to grow their earnings by 10% or more over any consecutive 5-year period. And those 22 companies outperformed the S&P 500 by 2.1% per year on average. And the same results held for international stocks. The M in Prime stands for management. Much like a skilled captain is able to steer their ship out of trouble, skilled managers are able to steer the strategic direction of their company even in difficult economic circumstances. Good management is unsurprisingly one of the most important factors in determining the long-term success of any business. A good management team is not just going to sit on their hands and accept whatever headwinds or tariffs come at them. They are going to actively look for ways to mitigate the impact. And while it's notoriously difficult to evaluate the quality of management, it's a very subjective thing, there's one way to find out from the people who know best: the employees. One of the indicators we find helpful when analyzing companies is to see what the employees are saying. and how they're rating their organization and management as a whole. One research paper from Georgetown University showed that aggregate employee ratings about their employer are an excellent predictor of future stock returns. They found that the companies that are in the top third of Glassdoor's ratings outperformed those in the bottom third by approximately 10.8% per year. And a 2011 research paper found that Forbes magazine's 100 best companies to work for tended to have persistent outperformance in their stock price. In other words, the market tended to underappreciate the impact that satisfied employees and, by extension, high-quality management can have on a company over the long term. The last letter in PRIME stands for essential. During the COVID-19 crisis, the Harris poll asked 2,032 Americans what they thought were the most essential companies in the United States. Here is that list. You may notice some of these companies are familiar. They may have been in your portfolio either currently or in past years. And those include UPS, Microsoft, Apple, Home Depot, United Health Group, McDonald's, Costco, Pepsi, and a few more. These are the companies that, even during a global pandemic, were at the top of people's minds for providing things they still needed to use and buy every single day. These things were essential to their lives, regardless of what disruptions were happening in the economy. By investing primarily in these essential companies, we can insulate against recessions as much as possible while still retaining exposure to long-term economic prosperity. So while we do focus on buying quality companies in all market environments, we're honing our focus on these prime characteristics. And while not all of the companies in our portfolio are going to check every single box, we've gone through and rated each one of them according to these prime characteristics, and we're looking for ways to improve these over time. And in the companies that we're considering adding to the portfolios, we're looking at it through this prime lens. For example, these were the companies in the Cornerstone model as of April 15th, and how we rated them on these different characteristics. It's also important to recognize that we have other objectives for the portfolio, including certain dividend yield and growth criteria. So some of these companies are going to check boxes not shown on the list, but overall, we believe the portfolio is positioned well in this environment. According to our subjective ratings, we believe 80% of the companies in the portfolio have pricing power, 61% are resistant to tariff, 61% are innovative, 87% demonstrate management excellence, and another 80% are considered essential. If you have any questions or concerns, we'd love to hear from you. And as always, we appreciate the opportunity to serve you and your family as we navigate these challenging market conditions together. Thanks for watching, and we'll see you in the next video.